Welcome to the basic financial analysis, ratios, and performance monitoring in microfinance banks. This is part 3, lecture 7 of the topic. In our last lecture, lecture 6, we discussed the customer's cash flow statement. Today, we are discussing another topic which focuses on the bank's book of accounts. On this topic, we would be looking at the bank's balance sheet. But before this, we need to look at the workability of the balance sheet and what it wants to achieve. In the list of orders, we look at 1. Format. Financial statement varies from one institution to the other. The differences are as a result difference in addition or subtraction of items, which are appropriate for each institution's record and analysis. 2. The application and functionality in this exercise is less important as the emphasis is more on understanding the various financial statements used in microfinance institutions and its adherence to international standard and practice. 3. Difference. Financial statements of different microfinance institutions of one country can be compared to the ones used locally, nationally, and internationally. The basic thing is to understand the accounting equation and arriving at a conclusion. Drafting financial statement. Financial statements are prepared by making use of information generated from the trial balance. They are prepared with reconciliatory measures to avoid mistakes and act as checks. When posting to the balance sheet, items posted are the final output that makes up the accounting system. Without the financial statements, it would be difficult and impossible to calculate performance ratios of microfinance institutions. The balance sheet for any financial institution is an integral part to managing assets and liabilities. Remember, we are now discussing the bank's books of account and not the customer's books of account. Customers have their own account difference from those of the banks. The balance sheet. This is now commonly called the statement of financial position. But for ease and clarity, we will be making use of the term balance sheet. In defining the balance sheet, we say, this is a stock statement that takes into consideration a snapshot of the microfinance bank's assets and liabilities at a particular point in time, with the date of transaction applied at the top of the balance sheet. Also, the balance sheet statement highlights what the microfinance bank owns and is being owed in terms of its assets and liabilities, and the differences show the net worth for a particular period. Finally, the balance sheet is compared in order to get a meaningful result on the growth of the microfinance institution and how well the resources are being managed. Note, the balance sheet must always balance, and this is because all debits must equal all credits, which are a basic accounting process in the balance sheet analysis. Components of the statement of financial position. Balance sheet. The statement of financial position has 3 major components, namely, assets, liability, equity. Assets. This represents what the microfinance institution owns or presently has. Most organizations seek funds externally or borrow money from other sources in order to build their asset base. These borrowed funds are invested into the MFI's activities. The International Financial Reporting Standard recommends that assets be recorded according to their uses. Let's look at the asset items. In the listed table below, numbering 1 to 10 in the asset column. We start with cash and cash due from banks. Reserves at central bank, short-term investment, loan portfolio, and advances. Loan loss reserve, other short-term assets, long-term investments, fixed assets, and depreciation. As seen in the total, only items 1 to 8 can be summed up. You can pause the video lecture to have a better read of the item descriptions. Liability. These are what the microfinance banks owe to other people or institutions. Microfinance banks incur liabilities that must be settled off at a specific date in the near future. Liabilities are a very good source of fund for the OPRAT of any financial institution because they are efficient and effective ways that revenue can be generated. Most of the money borrowed or generated from savings is given out as loans with normal or higher interest rates to deserving clients who are expected to pay back at specific dates. This source allows the institution to increase the liquidity status of the business. The liability items. In the listed table below, numbering 10 to 18 in the liability column. We start with savings accounts, voluntary or forced or fixed, deposits from other banks, loans, commercial bank or Apex, other short-term liabilities, tax payable, dividend payable, trade and other payables, and long-term liabilities, as seen in the total. Items 10 to 17 only can be summed up. You can pause the video lecture to have a better read of the item descriptions. Equity. Microfinance bank equity is also recognized as net worth or capital, and it shows what the microfinance bank owns or has. This is made up of accumulated surplus/deficit from the MFI's business transactions. Activities in the equity determine the payment of dividends to the shareholders of the business. Equities are not subject to repayment, since such causes a reduction in the value of capital for the MFI. This is an advantage since the money can be reinvested or used to maintain operating expenses. Equity can come in two components, namely 1. Contributed or paid-in capital. 2. Privately invested contributed capital. Let's take a look at the equity items. In the listed table below, numbers 19 to 24 are in the equity column. We start with shareholders' equity, donations, retained earnings, previous or current, and other capital accounts. As seen in the total, items 19 to 22 only can be summed up. And for the equity to balance, you will add the total liabilities and the equity to match up with the total assets. You can pause the video lecture to have a better read of the item descriptions. Please note that equity composition takes different forms and items for different institutions. And also, not all items listed above are usually presented in a statement of financial position. Let's take a look at this balance sheet template. Assuming we have populated figures in the template, we would see something that looks like this. Let us discuss the comparative balance sheet. When we need to compare balance sheet activities for different years, we have something like this. Looking at the balance sheet, we have the name of the microfinance institution with the title just above the table. This is to specify what periods own the record of the balance sheet. Another important detail on the comparative balance sheet is the dates on the values for the 2 years. The date is very important to know which year is being compared, while other asset items remain the same. The loan portfolio is being broken down into current, past due, and restricted. This is to identify the performance of the portfolio that the bank currently holds. A careful study is required to understand the information of the balance sheet. The assumption that this information is for accountants only is the main reason microfinance professionals and lending analysts have been novices in understanding the balance sheet and its comparative structure. We took the balance sheet analysis for December 2018 and compared it with that of 2017. Let us dive into depreciation. This is principally the wear and tear of an asset due to its usage, which causes such asset to lose its value over time. When an asset decreases due to usage, depreciation allows systematic allocation of value throughout its useful life. We require 3 main inputs to properly calculate depreciation. Useful life shows the time period in which the business considers the asset expendable. 2. Salvage value. After the useful life of the fixed asset, the company may consider selling it at a productive reduced amount. 3. The cost of the asset. The actual cost incurred in getting the asset, which includes taxes, shipping, setup, etc. We would be ending our lesson with depreciation types. We would be listing them in no particular order with advice to do a deeper study on them. 1. Straight line method or fixed installment. Reducing installment method. Annuity method. Sinking fund amortization. Insurance policy method. Revaluation method. Sum of the year's digits method. Double declining balance method. Depletion method. Final note. Items in the balance sheet are different for various microfinance banks, as source of funds and use of funds differs from each other. Hence, the need to make use of the present activities engaged in. This concludes our Lecture 7. See you in Lecture 8. And do remember to subscribe to receive notifications as soon as we release more lectures.